I mean, when you got silver making a historic move, literally something that it's never done before in nominal terms, some kind of a squeeze in this market where, somebody takes a huge amount off the market, that causes some turmoil at the exchanges. That causes everybody else who's in the same boat as that first big buyer to panic buy, and then silver goes to who knows where. As the saying that's going around now goes, it becomes unobtainium.
China did what it did, its master plan. They saved half of everything they earned. That's how China came from the Middle Ages to a dominant economic superpower. They didn't use foreign capital. They saved their money.
Silver's latest surge is exposing deep structural stress across the global metals market. As physical supply tightens and industrial users secure long-term stockpiles, the exchanges are showing signs of strain, halting trading, widening spreads, and signaling that available metal may no longer match outstanding paper claims. At the same time, gold is stabilizing at elevated levels because large, non-price-sensitive institutions continue accumulating tonnage, reinforcing the idea that a monetary reset is quietly underway. Together, these forces point toward a repricing cycle that favors hard assets and penalizes inflated paper systems dependent on confidence rather than scarcity. John Rubino, a macro analyst known for tracking currency decay and systemic risk, and Dave Collum, a longtime market observer and economic historian, described today's setup as the early stage of a genuine squeeze. With industrial consumption rising, stockpiling accelerating, and deficits deepening, silver is approaching a point where even higher prices cannot unlock new supply. Meanwhile, gold's resilience reflects the shift from speculative trading toward sovereign accumulation and stablecoin backing, anchoring a broader move away from fiat volatility. This evolving landscape suggests a powerful upside cycle for both metals as monetary systems reprice in response to scarcity. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I mean, when you got silver making a historic move, literally something that it's never done before in nominal terms, the fact that silver wasn't really fazed by it, although silver's down today, so maybe we've got a delayed reaction happening today. But at the time, silver wasn't phased. A lot of people didn't pull out, and volume didn't crash, and silver didn't go back down another couple bucks an ounce. It just held on to an all-time high. That's a good sign. That means that people are interpreting the commodities exchanges playing games as a sign of weakness rather than a sign of strength, and which they should. I mean, that when commodity exchanges do things to stop trading, that means they're worried about what's happening if they don't stop trading. And that is a very big sign of weakness. That means they don't have the metal on hand to make good on all the claims on that metal that are now trading on their exchanges. So, I mean, and that's the case. It's kind of a fractional reserve banking system in the metals markets, especially silver, where there are claims that dwarf the amount of physical metal that's available for delivery. And so you can't have all those claims stand for delivery because the metal's not there. So they're doing things to prevent that. And I suspect at some point they fail, because the industrial demand for silver is so high and rising, and the supply of silver coming out of the world's mines is inadequate for the industrial demand. And then you've got monetary demand happening at the same time. As gold goes up, silver gets pulled up via the gold-silver ratio, and there's just not enough silver to satisfy all the potential claims out there. So I think everybody's watching this with interest, because everybody in this market can see the math, and the math is very unfavorable for the exchanges and great for silver. So seeing that, if you're if you're General Dynamics and you need silver for missiles, you're going to go out and get as much silver as you need for the next few years' projected demand, right? Because you're not going to stop supplying missiles to the Pentagon or to any of 50 other countries that are buying from you, just because you couldn't get enough silver or the price of silver was too high or something like that. You're going to satisfy your customers whatever you have to do to get the ingredients for the systems that you need to put in your missiles. So spread that across the entire industrial economy, and you have a lot of stockpiling going on, maybe. Once again, in the face of a big deficit and shrinking above ground supplies. So we're getting close to the point of some kind of a squeeze in this market where, somebody takes a huge amount off the market. That causes some turmoil at the exchanges. That causes everybody else who's in the same boat as that first big buyer to panic buy. And then silver goes to who knows where, as the saying that's going around now goes, it becomes unobtainium. You can't get it at any price. And there are some people who just have to have it. So it'll be interesting to see what all this elasticity stuff does to the market when we find out that the supply is inelastic and no price is going to get you what you need. So we'll see. I mean, there's a good chance that something like that happens. We don't know when it happens. We don't know what the sequence of events will be, but we're creating the conditions in which there's a massive short squeeze in silver, and you basically want to be there for that, right? You want to have your stack created and stored in the right place, because that becomes a life-changing event for you if you're heavily invested in physical precious metals, as everybody should be who's listening to this. Gold had a hell of a run, and you would expect actually a much bigger correction than we got, because it blew through $3,000 an ounce and then through $4,000 an ounce, which created a lot of profits for people to protect. So it wouldn't be a surprise with a chart like that for a lot of people to take profits up above $4,000 an ounce and for it really to knock down the price of gold. That doesn't happen is probably because central banks are the whales in this market right now. And they're not price sensitive. They are tonnage sensitive. They've been ordered to accumulate X tons of gold. And so they're buying it regularly without worrying about the price, because that's not the issue for them. So we're getting a consolidation here, but not a very big one, not the kind of stomach churning correction that chases weak hands out of the market. So, as long as the central banks are steady, if not aggressive buyers, then that kind of puts a floor under gold, because you've got big people who have monetary printing presses who apparently need to accumulate a lot of gold. And then look over at the crypto guys, and you've got entities like Tether that are setting up gold-backed stablecoins, and they have to buy a lot of gold and store it to back those stablecoins. And Tether is now, in terms of the amount of gold that it owns, it's up in the central bank range there. It's comparable to brand name country central banks, and it's just one stablecoin company. There are probably several others that are thinking about jumping with both feet into the gold market, because that's a really logical kind of stablecoin product there. So you've got a lot of really non-price sensitive buyers in the gold market right now. And that doesn't mean gold goes straight up from here, but it means that the wind is at the back of that metal's price. And that explains why we're not seeing the volatility that you would normally see in this wild bull market like we've otherwise seen for gold. So I don't know what to draw from that other than the gold thesis is still intact. We still might see some corrections out there, but it feels like there's a repricing going on. There's kind of a monetary reset going on in the world right now, and it's unofficial, but a lot of fiat currencies are being swapped for gold, obviously, with central bank buying like this. And there's a goal in mind for that at some point. The end game somewhere out there is for a lot of central banks to be able to back their currencies with gold. And we'll have to see how many of them actually do something like that in an explicit way. But I think that's part of the story going forward for gold and for silver, that there's a monetary repricing happening, and we're going back to the old kinds of money that can't be inflated away. And that's a very good thing for gold and silver one way or another.
Silver's recent behavior signals a market entering a stress point that can no longer be hidden behind paper contracts. Industrial demand is rising, above-ground inventories continue to shrink, and large buyers are quietly accumulating years' worth of supply to avoid production risks. This tightening environment increases the likelihood of a disorderly short squeeze, one driven not by retail enthusiasm, but by industrial necessity and exchange vulnerability, in which physical metal becomes scarce and price discovery shifts sharply upward. At the same time, gold's resilience reflects steady accumulation from entities unconcerned with price, reinforcing a silent monetary repricing across global markets. As strains emerge across currencies, bonds, and the overextended equity complex, capital continues to rotate toward tangible assets with verifiable scarcity. These pressures could accelerate dramatically as deficits widen, interest rate dynamics fracture, and commodity stockpiling intensifies across multiple sectors. Let's get back to the interview.
Well, I think the silver thing is a potentially big thing that some people might call a black swan, but it just looks like the math working out. So we get a squeeze in silver. Another thing that might come along with that is something similar in copper, because that market is pretty tight. The yen carry trade, which we've already talked about blowing up, is a potential. Again, it's a black swan to anybody who's not paying attention, but it's a very big possibility as a crisis out there, and the biggest thing of all, though, might be the Fed easing aggressively, which it's already getting ready to do. Trump is getting ready to replace Jerome Powell as the chairman of the Fed with one of his guys, some of whom have been explicitly talking about a big drop in the dollar's value and much lower U.S. interest rates. So let's say we have the Fed do that, but the bond markets don't play along. In other words, the Fed cuts interest rates, but long-term rates go up because the bond market is not buying this story anymore.
That happened last year.
And then that means that's right. On a relatively small scale, though. Rates went down at first when the Fed started cutting, and then the 10-year yield went back up to kind of where it was before. But it could be bigger this time, where it spikes to some unmanageable number. And then you got everybody looking at the government's interest expense, which is now $2 trillion, and that dwarfs the military budget by 50%. That kind of thing. When you see that kind of math on CNBC and CNN, then people get seriously spooked, and nobody wants to own the bonds of a country that is running those kinds of numbers. So something like that is conceivable in 2026. And if that happens, then that means we're kind of at the end of the fiat currency experiment. So this is potentially very big for economic history. We tried this experiment starting in 1971, where we trust governments to effectively and honestly manage our currencies. And they basically screw it up on an epic scale. And so over the next 50 years, we become more and more deeply indebted. The 95% who aren't super rich become debt slaves to the 5%. And we end up with civil unrest on the streets and in the financial markets on a scale that we've never seen before. So anyhow, that could all happen. I'm not saying it does, but it's a very plausible scenario. And then you get, of course, the monetary reset. So we are going to live through that part of monetary and financial history, which is fascinating on the one hand and absolutely terrifying on the other hand.
China did what it did, its master plan. They saved half of everything they earned. That's how China came from the Middle Ages to a dominant economic superpower. They didn't use foreign capital. They saved their money. That's owning silver miners, gold miners, gold, silver, platinum. Platinum's a great bullish story. You want a bullish story? I'm not talking momentum. I'm talking a flat-out bullish story. Platinum is a phenomenally bullish story based on fundamental logic that Graham and Dodd would love. So that's where I'd put. If you put a gun to my head and said, buy something for bullish arguments, I'd buy more platinum, which I bought 9 times this year. And I didn't buy anything else. I already owned it. Too much silver. But yeah, platinum has got way better fundamentals than any metal that I know, based on what I can figure out. The above ground supply is minuscule. A small hedge fund could buy it all at current prices. It's been a deficit production for a number of years now. By some math, and I'm going to throw out a wild number because I'm going to get it wrong, but in something like 3 years, the above ground supply will be gone at the deficit at the current rate. You get it from South Africa and Russia. South Africa could shut down in a heartbeat. It's a failed state in the making. And you're not going to not sell cars with catalytic converters with platinum in them because the platinum costs too much. You're just going to pay whatever you have to pay. And by the way, the hybrids use more platinum than internal combustion engines. So as we go to hybrids, which are I think the logical technology to go to, not EVs, hybrids, we're going to sell more platinum. So my risk assets, the ones I control, there's stuff I have some stuff I don't control. I've got fixed income, which basically you get 4% whether you like it or not, and a house, which I have to include because it's worth too much money. Although who's going to buy it, right? I already made that case. But the risk assets I control, I'm up 65% year to date, and I'm grumpy because the market is broken, and the S&P is up something like 21%. Does anyone think the S&P grew the ability to produce wealth 21% this year? Does anyone think that from 2015 to the present, where the Mag 7 have gone up 10x while their average revenues are up like 2x? Does anyone think that's normal? No, it's not normal. And I'm frustrated because I think I'm going to go to my grave not being given good opportunities. And by the way, if you buy Philip Morris or something, when they hit the sell button on their S&P 500 index, Philip Morris is going to sell too, because it's in the index. Now, the Mag 7 are going to non-linearly get whopped because they got non-linearly boosted. But when the average investor decides it's time and they're starting to get creeped out, and they go, I've got to thin down now. And if the market starts dropping, they go, if it drops any more, I'm not going to be able to retire. So I've got to get out of these goddamn markets, right? Everything. They always say everything sells, but that's because people panic and sell. You only have one choice in passive investing. You sell the whole market or nothing. You can't tease NVIDIA out of there. You can't tease Tesla out of there. You can't tease Microsoft out of there. Apple hasn't invented anything new in how many years? 15 years, right? How many $4 trillion companies are there? The NVIDIA is now bigger than the market cap of Japan. This is going to be the chapter of a textbook. Right, it's going to be like the Imperial Palace being worth more than the state of California story, and I at some point I think we're going to hit a bottom when Jensen Huang is in an orange jumpsuit. That's my suspicion.
Silver's surge into unprecedented territory is revealing the structural weaknesses of the paper-based pricing system that has dominated the market for decades. Physical demand is stretching available inventories. Industrial users are quietly securing multi-year supply, and exchanges are responding with defensive measures that signal strain rather than strength. When markets halt trading to maintain order, it reflects a more profound truth. The physical metal needed to honor outstanding claims does not exist in sufficient quantity. At the same time, gold's consolidation above new highs shows the influence of steady, non-price-sensitive buying from major players who understand the unfolding monetary reset. Across the global economy, the shift is unmistakable. Capital is migrating away from overvalued financial assets and toward tangible stores of value that cannot be printed or diluted. The combination of sovereign accumulation, industrial necessity, and shrinking above-ground stocks is setting the stage for a revaluation that could move far faster than traditional models suggest. As monetary credibility weakens and inflationary pressures intensify, the metals complex is positioning for a phase in which scarcity becomes the defining driver of prices. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.